Okay, so what you're looking at is the Office Ops monthly cash flow template. It's available on our website, office-ops.com. It's on our resources page. It's something that you can download, make your own copy. You can change whatever you want and really make it your own. So a cash flow template or a cash flow document is used to do a forward projection of what your bank account balance is going to look like. The reason I call this webinar Stay Positive is because, as all of us know, bank accounts don't like to be negative. So they really do like to stay in the positive. And in general, most businesses are able to keep their bank accounts in the positive. So that's why we start putting these numbers together. So we start putting the income, our beginning bank balance and our income and expenses over the period. And then we really get to see a good picture of if our business is running aground or if we're profitable or not based on our cash flow. Okay, so this is a cover sheet. You can see there's 4 tabs. This is our cash flow itself. This is our cash in, cash out. This is going to be kind of more of a warm up. So this is where you put our company name. What's your company name? This is where you're going to want to designate if you're an LLC, if you're a partnership, or if you're an Inc. Any of that is helpful to know when you start doing things like cash flow, because it may change. How you do things like distributions and stuff like that. The next item is industry. So this is the sector of the economy that you work in. So different sectors would be hospitality, construction, manufacturing, software. So these are the industry trends that you're going to look to when you start looking at filling out your cash flow income projections. That's where you will say, is our industry affected by, COVID-19? So business model depends on the business. And even if you're in the same business, in the same industry, you may have a different business model. So there's a bunch of different ones. So let's say the most common or the simplest example is a direct product sales business model. Your business model is a description of how a company creates, delivers, and captures value for itself and the customer. A direct product sales would be buying raw materials, producing that item, distributing and selling that item to the end user. So that is your business model for product sales. Let's think of some other ones. So we have distributors who buy products and then resell them. We have a restaurant model, which is similar to manufacturing, but you buy raw materials, you produce a product, and then you provide an experience. So that's a slight twist. We have a fixed price model. Let's say that you charge every client $79 a month, regardless of how much it costs you to produce the product. That's a fixed price model. You have subscription memberships. That is, you have the number of people who've signed up or the number of clients who've signed up for your product over a certain period of time, whether or not they renew. That's your subscription membership model. Cost plus model is going to be, it costs you X amount of dollars to produce this. You're going to turn around and charge the customer X plus an amount. So that's a good one for construction. It is a lot of times cost plus model. So they'll charge for time and materials and also profit. And then lastly, we have some digital models that are new. We have things like freemium advertising models, which you provide a free product and have advertising dollars back it up. And then software as a service, which is similar to a subscription model, but you are providing software. So the other thing you'll realize when you start to flesh this out is that businesses can have several different business models for one company. So let's say my business has both a monthly retainer and a project time and materials business model in just my business. I only offer 2 products. They have different models. So both of those it's okay to have multiple, but that's where you want to start paying attention to what the products are and what the business model are for your particular business. So product sold, I only put 1, but per monthly retainer, or a widget or a website or a software subscription, whatever it is that you're selling, you would want to list here the different things that you're selling, because it's going to end up on your cash in. And then This also relates to your business model. And this is just a warm up for what's going to go into cash out. But when you start thinking about selling a product, what are the direct costs to produce that product? That's what you need to start thinking about when you start filling out in your cash in, cash out sections, tabs. So let's say that it's a professional service. You really don't have much direct cost to produce. But let's say you're a distributor, you are buying a product and reselling it. That initial cost is your direct cost. So that's going to show up a little bit differently when we do cash out. You're going to see you're going to have fixed costs and variable costs. Variable costs change depending on how much product you are producing. Okay, and then a cash flow projection is always as of one point in time. And then that cash flow is a forward projection as of one point. So that's why the bank balance is as of always as of the date updated. So this whole cash flow is really an April cash flow. So I'm just going to put 4/1 here. But basically, what we would do is we would put today's date, today's bank balance, and then when we go through the cash in, cash out sections, then we would update that to reflect what has been paid or not paid. Okay, so, and then lastly, this bank balance here is really just your operating account. So when it comes to the different accounts that you may have, savings or a money market or credit card account, a cash flow model, simple cash flow model is really only going to work with one account. So we want to use the main account. So operating account is usually what you're trying to stay positive on. So make sure that this is the operating account bank balance. If you want to transfer savings into this account, you can handle that through the cash in tab. So even if it's not income, if it's money flowing in and out, we'll have it on a different tab. Okay. So that is our warm up. And then this information is going to get grabbed by our model and then put on the different sheets. So just an overview of our cash flow projections tab. Anytime I come to a new page, I want to start at the top left so we can just work our way down. So we have our business name. These are our cash flow projections. So this is the summary sheet for the work we're going to do on income in and income out. This is our beginning cash balance as of the moment we're updating this cash flow. And then this here, this is the period that we're using. So we decided to use a monthly cash flow here. Some businesses need a weekly cash flow. Some businesses may want to have a different term, such as daily or quarterly. But I find in most cases, and most of the businesses I work with, weekly or monthly is the most effective and most helpful from a cash flow perspective. Okay, so we have our beginning bank balance, we have the cash in, the cash out. This is just the sum. Did we make or lose money during the period? The net cash per period, which changes per month depending on the different expenses and income projections. And then here's our ending cash balance. So one of the most important things to realize about your cash flow here is that the balance rolls forward. Nothing really changes when a month rolls over. It's just, for us, helpful. That's when rent is due. Oftentimes payroll is paid on a monthly basis. A lot of our bills are monthly, so that's really how this lines up well. But at the end of every month, the ending cash balance is the same as the beginning cash balance for the next month. And that's what makes this rolling. Because as soon as you affect something in April, you'll see it continues to affect the rest of the months. Okay, so we're going to go over to the income page quickly. And you can take a look and see what is on here. So I use the term cash in as opposed to income because this will include some items that are not technically income, such as the PPP, for example. It does not count as really income, but it is cash in. Transfers or owner investments may count as cash in, but not as an income item. So how do we look at this income projections? So we want to think back to our business model and start thinking of the different products that we're selling. So that's going to be here. So this is product sales. Um, don't type live. Got it. So actually, the first thing that I want people to look at in this model is accounts receivable. Not every business has a lot of accounts receivable, but some businesses are very heavy on accounts receivable. And this just means that someone owes you money. So this could be, another company owes you a refund, or you usually get a certain type of check once a year. Or this can be just your traditional, I sent out 10 invoices last month, 8 of them got paid, 2 of them are still owed. So and so is on a payment plan, whatever it is. Accounts receivable is going to be a make or break for a lot of businesses. And this is where you want to make sure that you have a clear communication with all of your clients, so you know exactly when that money is coming in. So let's say that a business this size has $10,000 of accounts receivable, and 4 of those invoices are not going to come in very quickly. We might schedule those out for June and discuss with that client, hopefully you can pay us by June, or talk to someone else about, hey, you just haven't paid because you haven't gotten the invoice. So here it is, please pay it in April. So this is where you have a lot of control if you do happen to have accounts receivable. Most professional services businesses do. If you happen to have accounts receivable, being on top of this and making sure that you're communicating correctly with all your clients is going to be critical to making sure that that's all received and not have to be written off. Because one of the things that might end up happening is businesses might start having to make hard choices about which vendors they're paying and which vendors they're not. So if you are on that list of who needs to get paid and who's registered that they need to be paid, you're more likely to get paid than someone who doesn't register that with them. Okay, so again, everyone's income is going to look different. So I'm just going to go through some different types of income. So here we have recurring revenue. That is a good one for, let's say, memberships or subscriptions. It's a good one for, I have a lot of retainers, so this is where monthly retainers come into play, and software as a service, different types of recurring revenue, service plans, any kind of thing, subscription boxes. So project or one-time revenue is a different type of revenue. So it can really be, like, I would think of it as project revenue. So let's say that you're a construction company and you are building a building. You may only have 3 projects at one point, but each one is the same type of transaction. So if you only have 3 projects, I would put each project here and maybe delete some of the other items. But I'm just trying to get you to think through like what a project would be. So let's say that you're a restaurant, a project might be an event rental, whereas day-to-day sales would be more like product sales. So now we have this other category here, which is product sales, and it's kind of lumping a lot of different categories into one, but selling widgets, distributing items, providing restaurant services, a lot of those different types of one-off or daily sales, any kind of retail is going to be product sales. So when it comes to projecting these, you can look at what you've had in the past, look at your recurring revenue. This is going to be the easiest one to project because you'll already have those customers and you'll be able to communicate with them or judge or guess with them which ones will continue on. Project revenue can be a little harder to predict because what it's really relying on is your pipeline. So let's say that you are in a construction company and you do have that long pipeline, things can take up to 6 months to a year to close. It can take you a while to figure out if you're having a pipeline issue or not. But in general, what you want to look at are your prior trends in this arena for projects and make sure that you are projecting out either the same or adjusted based on what you expect those projections to be. Same with product sales. Let's say that you, during a busy month at your restaurant last fall, you were making $4,000 a month, and now we're at 25% capacity. You could put $1,000 a month, or something like that. So you want to try to use objective numbers as much as possible, which is why looking at prior data, especially seasonal prior data, is really going to be instructive to help you at least do a baseline guess. And then you can start to figure out more what percentage of your business is going to be affected, right? Okay, so here you can really, depending on the number of clients, you can really add a bunch of rows, add every client, map out everyone if you'd like. I think that, up to a certain size, that is really helpful. The same thing with projected revenue. So really what happens is this here, right here, this purple or this pink section is just stuff that you think is going to happen. I would say up here is most likely going to happen. So let's say we know we're going to have our restaurant open. We just don't know what the volume is going to be. I would put it in your sales section. If you're going to open up a new revenue stream, or you're going to open up gift cards, or you're going to sell a new product, or you have to go looking for new projects, that's why I would start using this projected revenue section, because that's when you start to think of different types of activities that might be changing that pipeline. Okay. And then cash in, other items. So I have the PPP here, which some people may have already received. Some people might still be waiting for it. Some people may not have applied for it. A lot of people have questions, so it's in here. We have the EIDL, which a lot of people have received at this point as well. Loans, different types of loans. There's state loans, bank loans. That can also help. This could be your SBA loan. Savings transfers, let's say somebody has money in a different account and you want to bring it into this operating account for cash flow purposes, you would put that in there. And then owner or investor investment. Let's say that things are, all you need is $2,000 to get through the summer, and your owner, the owner of the business, or you are able to make that investment, you would just put that in here as an investment. Okay. So let me go back to this for a second. So just some things to consider. This is kind of an art, right? Projecting your income. And it's not something that is usually done perfectly overnight, but it is something that I will tell you, if you do this every month for 6 months, you will have a better idea of what your products are and what you're actually selling. And then you'll have a better sense for if you met your sales goals or not. So let's say that we have $7,000 in recurring revenue by September. If we're filling this out in September and we have to downgrade that to $4,000, we're going to know we made a mistake. So similarly, if we're starting to work with much larger numbers, we'll know that we exceeded our sales goals. And I also like to, during the first pass of my income and expense, I like to keep my income conservative and my expenses high. And then we see where the overall cash balance shows up, and then we can make adjustments from there. So that's where the magic happens, after we go through our first pass of adding everything in. Okay, so here's the expenses page. Give me just a second. Let me sip the water. Okay. All right. So again, your expenses, really, your cash out, because some things are not expenses, such as credit card payments. The first thing you want to consider are your cost of goods, right? So if you don't have this, you don't need to consider it. But if you do have it, it can make up to 75% of the expenses for your business. And that's something that you really want to be making sure you're projecting accurately and correctly out here in your cash flow model. So you can do other things like add a formula and say, if I sell 50 items, it will cost me $3 an item. And you can start to set up different items here in these estimates. But in general, you just want to look at historical costs, historical sales volumes, and try to project forward your raw materials costs, as well as subcontractors. That's kind of for construction, but any type of subcontractor that you might be using. Let's say that you build websites and you hired a developer for a part of it. That type of subcontractor, you want to make sure that you're projecting out with your projects. And then cost of distribution and sales is another cost of goods. It's one thing, you made your product, now you have to package it and actually get it out there. So that's the type of stuff that you want to make sure that if you're projecting an increase, so this is a variable cost. If you're projecting an increase in sales, you need to make sure the cost of goods sold are also increasing, because you can't sell more beverages or widgets if you don't make them and pay for them. So that is an important piece. Okay, so then we have staff. So this is one item that's seeing more scrutiny now after the PPP. So the PPP is a 2.5% or 2.5 times monthly payroll loan. So people are looking very closely at their projected staff expenses to see if they can cover that and to see if they need the PPP. So here we just have some simple projections. I have 3 employees times $2,000 a month equals $6,000 estimated salary per month through the end of the year. Salary is less likely to be variable. It's really more fixed cost. Hourly tends to be more variable. Let's say your restaurant is closed, you don't have staff. Your retail shop is open, you don't have a retail person working. So hourly tend to be more to have more fluctuations with your current business situation. Contractors, you could have a social media contractor, a developer, different types. And then professional services, bookkeeper, lawyers, different types. So yeah, you really just want to look at your monthly estimate. And the thing is, with this whole sheet, it's based on the monthly estimate, but let's say that you're going to have a $3,000 legal bill in May, just type that into May. That's the type of flexibility that you want to be building into here. So you know where all your funds are going, and so you are not confused when you come to update this in a month. Okay. So another thing, this is one of the ones that you're going to want to play with a lot if you need to make cuts once you look at the overview, but we will look at that in a minute. So now we're down to operating expenses. These tend to be fixed expenses and not fluctuate nearly as much as hourly or cost of goods. So rent generally doesn't change. If you end up getting things like forbearance, you can change the amount in here. Health insurance for your employees. You don't want to include items that were paid on your credit card because you have credit card payment down here. But let's say that your cell phone, office phone, and internet come out of your operating account, you'd want to put that in here. Travel, I just removed that for now because nobody's really doing that. But let's say you have trips planned, you can budget out there the different travel expenses. Meals and entertainment is another one that's going down quite a bit during this coronavirus situation. And it's actually, there's no more entertainment, so it's just meals. So office and computer supplies, advertising and printing, legal and professional fees, insurance, bank and credit card fees, utilities. All these are pretty common expenses that you want to look at when you're filling this out. Utilities are supposed to be forgivable under the PPP as are health insurance and rent. One-time expenses. So this is something that always comes up out of the blue. And whenever possible, it's best to project your one-time expenses, right? So let's say that, your car is in bad shape and you're going to have to get the alternator replaced or, car piece replaced. Just put in, it won't kill you to put in $2,000 in June, leave a little comment, alternator replacement. This is 6 months, a lot can happen over 6 months. So you want to start thinking of, am I going to be able to live without, investing, buying these curtains or buying this other thing, so like you need to start thinking about also when you're reopening, Are there going to be costs to, printing new signs or changing the way tables are set up or any of those things? So your costs to reopen, any improvements or assets you're going to have to purchase in the next period of time. Accounts payable is really a line item for anything that you still owe that you haven't paid yet. So let's say that you're still haggling over a bill with, a car dealership, you still owe them, but they haven't decided. You want to just put that in here and you want to start budgeting that out when you're going to be able to pay for that. Because when you start looking at your cash in, you might start realizing that you'll need to make some adjustments to hit some of these expense targets that you have. Okay, and then down here at the bottom, I'm going to call this is other activities, financing and equity. So loan, line of credit payments, a lot of those are going into forbearance right now. So if you can't make those payments, you can usually get in touch with your bank to have those postponed for a couple months. The same thing with credit card payments, or you can pay the minimum. But here you're really just going to you're not going to put the balance owed on your credit card. You're just going to put the amount that you're going to pay every month. Then we have owner's draw. So owner's draw sounds fun, but for some people, it's really not optional. Many people started their own business to support themselves. So owner's draw in many ways is just as important as salary. So other times people start businesses for different reasons. Sometimes, all I'm saying is sometimes owner's draw is more flexible than it is in other situations. And then I have here taxes. I don't have anything projected, but in general, if you're making quarterly payments, you want to make sure that you at least have something budgeted in here to make those payments. Okay, so let's see. Yeah, so yeah, I would say some of the most important things, really think through this cost for each unit produced. And then one-time expenses, they will definitely bite you. So make sure you're really thinking through what you need to pay for. Because the better you are at projecting those one-time expenses, the better you're going to be at affording them and budgeting for them. So that's what we really want to see here. So, okay, so we have our cash out amounts per month. We did our income. So now we are going to go to, drum roll please, the big picture. Okay. So, big picture, overall, how does this look? Is this cash flow positive? It's not a positive cash flow. It's a negative cash flow. So I had projected a dip of income in June and then trying to come back close to October, as well as having some new expenses pop up here in September. So let's see what we can do here. So April, maybe we can, usually what I try to do when I try to make our cash flow positive is I try to start with where we're at and kind of what we can do now. And so we want to can slowly make these changes over the next month. And what we don't want to do is just say, okay, well, we can bring in $2,000 more income every month and just pull that apart. So we want to be strategic about how we're changing things. So let's look at April and let's see, we're the business owner. What can we cut in April to try to get through this? Okay, so right now we haven't received any PPP. We're going to have to cut hours for the hourly people. We're going to have to cut our social media contractor, unfortunately, for a few months. Sorry. And then we're going to ask our landlord to go into forbearance for the rent for April. Okay, so let's see how that affects us. So we still have these bills that need to be paid. They're really good at following up, so we have to make sure that they're paid. How does that look? Okay, that looks good. April looks better. May doesn't look so hot though. May is short by about $1,000. So let's see, we already cut that. We're going to continue our cuts with our hourly people. We are going to stop eating out. We cannot stop paying insurance. That's not an option. And we're going to get forbearance on our loan. So let's see if that works. Okay, great. That worked. it's a little tight. So let's extend some of those cuts. I'm going to try to get forbearance on my loan for the next month. My owner's draw, it's a tough month, but I think I can make it survive on 750. I'm not sure many people can, but put it there. And then really when things start slowing down, we're going to not be able to have the same number of employees. So we're going to have to cut someone on salary here. And then we're going to have to sustain those cuts until things get back to normal in September. Okay, so we made some new cuts. Now let's see how our cash flow looks. Better. It's looking better. So we have here a really short income month in June. So let's see. So we have our recurring revenue down to $3,000 in June. That is really rough. I'm going to work extra hard to try to make sure that we don't lose as much recurring revenue and not have this dip here. So I'm going to assume that we're not going to lose as many clients as we thought we were. I'm still going to lose a lot of product sales. And then this new project that I'm starting is going to come in soon. So let's see. Okay, so that helped a little bit. So let's see. We're going to have to continue these cuts. Can't hire our social media contractor back on through June, through the end of the month. We're just going to not eat out. Not going to happen. And then we're going to delay this asset improvement until September. Okay. And accounts payable, we're going to talk him into $1,000 now and $1,000. Okay, let's see where we're at now. All right, so we're still short. So here's where the PPP can come in. So because we have these projections of being short on revenue, thousands of dollars, we might be able to get a PPP of $10,000, $11,000. Let's say we get that PPP. How does that put our cash flow? Much better. So I know the PPP doesn't solve all our problems quite like that, but in this case for the cash flow, as much as we made cuts, now we're able to get back to November, back to opening up cash flow positive. If we did not get our cash flow, if we did not get that PPP, we would have had to look a little more closely at how we're going to bring in more revenue, you know, and find ways to make more cuts. So that's what this tool really does. This tool really gives you the flexibility to look and see in real time what those different changes are going to do for your bottom line and what's going to help you stay positive with your cash flow. So yeah, so that is it for the screen share. I'm gonna see if anyone has any questions, any Q&A. If not, I actually am gonna go back here to look at one more thing. It's not working. Okay. So I actually can't get that to work. But yeah, if anyone has any questions, let me know. Otherwise, I'm going to answer some questions I have for the Q&A. So the first one is, how do we know that our business is going to experience cash flow problems? And so there's a few ways. One is that if you have a lot of receivables that haven't closed, that's going to cause you cash flow problems. If you're not really in touch with your expenses and you find yourself with a lot of operating and overhead expenses as opposed to direct expenses, that could be another indicator that you might be having cash flow issues. If you are looking at overdrafting on a regular basis, that could be a symptom of cash flow issues. But what can help you overcome some of those cash flow issues are some of the things that I talked about. So following up on your receivables regularly and on an ongoing basis, making sure that those customers know that you're looking for those funds and they have easy ways to pay. So that's why I like suggesting the implementation of credit card payment processors and bank drafts and things like that. This way, a client can pay when they're ready to pay without having to, write a check, get it to you, or things like that. There might be some fees, so that's something that you have to consider too, about the expediency of when you're getting those funds versus paying that fee. But that is something that can also help. You can look at ways at delaying investments. You can look at ways to negotiate terms with your vendors. You can sell assets. And then really, I think the best tool to managing cash flow issues is to be really in touch with your expenses and to make sure that you're looking at them at an ongoing basis. So that's why the tool is important. You're supposed to review that tool every month. So if you go through every month and you look and see where should my bank balance have been and where did it end up being, and then you go through the steps of making sure that you understand why there was a difference, then that will help you understand why you're not making the targets that you thought you would and why your bank balance might not be where you want it to be. Okay. So we have another question. Doesn't QuickBooks do this for us? So the short answer is no. It doesn't do it for you. What it does is bookkeeping. So it will tell you things historically. So that historic data is really important to be able to inform your current data and your projections, but it isn't going to help you look at the future. I will say if you have QuickBooks Advanced, which is quite expensive, it comes with a plugin now that has Fathom, which is a cash flow projection. So that could work. And then also they started doing some graphs and things, but the reason I created this Google Drive tool is because QuickBooks does not do this, and there are not simple, affordable tools to do cash flow. So like you saw, our cash flow is really just getting the information down, putting your projections on paper, mapping them out, and then putting a sum to it and seeing where we end up. Okay. So, and then how do we know if this model is accurate? So that comes when at the beginning of every month when you review it. So the first thing you do before you start updating is you take a look at your bank balance and you take an honest look and see if it's where you thought it was supposed to be. If it's not, you either need to work on the model or you need to work on your spending and your income. So I updated one today where we went through the accounts receivable, and half of the accounts receivable that we projected to receive hadn't come in yet. So that's a problem. And he didn't necessarily know that that was an issue that he was having because he wasn't looking at it. He was out there looking at sales and hustling in a different way. So that's why you need to make sure that you always have your eye on your QuickBooks and your receivables and make sure that those are followed up in a timely manner, because if not, people could be walking away with your money and spending it on something else. Okay. Do I have any more questions? All right. It does not appear that I have any more questions. So with that, I want to thank everyone for attending and for watching me walk through this cash flow model. Like I said, it's really my favorite thing, my favorite tool to use. And I think it's really instructive and really helpful to the clients that I use it with. So again, I'm Teresa. I'm with OfficeOps. So if you have any questions or you need additional support, you want to go through a cash model of your own, you need QuickBooks help, you don't know what to do with payroll, that's the type of stuff that I help entrepreneurs with. So I work specifically with small and growing businesses. So I work with solopreneurs up to people with about 10 employees. So if you need anything, go to office-ops.com and we'll help you out. Okay. Thank you all, and see you on the next webinar. I'll let you know. All right. Bye.